Good afternoon and welcome to today's third Analytical Corner. My name is Sebastian. I work for the Secretary's Department. And my colleagues Mehdi and Nordin will present to you their findings on the nexus between climate and monetary policy. The presentation will be followed by a short Q&A session. Please do not forget to switch your phones back on after the presentation. Now, join me in welcoming Mehdi and Nordin.
Thank you. Good afternoon, everybody. Today, we are very excited to discuss a topic that is gaining significant relevance, which is the intersection between climate change and monetary policy. And we will do it in the context of the Middle East and Central Asia. Climate change is one of the most global pressing challenges. In the Middle East and Central Asia, the situation is especially critical. The region is already prone to extreme environmental conditions, and global warming is only making matters worse, leading to more frequent droughts, accelerating water stress, and increasing desertification. But here's something we must all acknowledge. Climate change is no longer just an environmental issue. It is becoming an economic challenge, one that is reshaping the way we think about public policy, including monetary policy. Central banks, traditionally focused on price stability, are now facing new climate-related complexities that they cannot afford to overlook. I am Mehdi Leradi from the African Department.
And I'm Nordin Abidi from the Middle East and Central Asia Department. Today, we'll share findings from our recent research on how adverse climate conditions could affect the conduct of monetary policy in this region, and whether it complicates or supports the achievement of central banks' primary mandate, price stability.
Let's start with where this research began. A few months ago, Nordin and I were reflecting on the global inflation surge that emerged after the pandemic in 2020. The nature of this inflation has been widely debated. Was it driven by supply shocks or by a rebound in demand? Was it transitory or more persistent? While these questions have dominated global discussions, one thing stood out for the Middle East and Central Asia. Food prices were a major driver of inflation in the region. Now, why is this the case? Food prices can fluctuate for many reasons. Global supply chain disruptions, conflict, domestic demand surges. However, in this region, climate change is a dimension that cannot be ignored. The impact of climate conditions on food production has become a significant factor, particularly as we observe more extreme weather patterns and resource scarcity.
To visualize this, we looked at temperature data going back to the early 20th century. As this figure shows, temperature in the region began to rise sharply in the late 1980s and early 1990s. This marked a tipping point, triggering more frequent and severe drought, intensified water stress, and rapid desertification across several countries.
But the story doesn't end there. Complicating matters further is the structure of household consumption in the region. In many countries, food accounts for as much as 40% of the consumer price index. This is significantly higher than in most other regions. Now, think about what this means. When food prices rise due to climate-related factors, the overall impact on inflation is much more pronounced. For households, which are already spending a large portion of their income on food, price increases hit harder. For central bankers, this presents a particularly challenging scenario. Traditional monetary tools, like interest rate adjustments, may not be enough to address inflation driven by food prices, especially when climate factors are at play.
So let's pause here and reflect. Imagine you are a central banker in one of these countries. On the one hand, you face worsening climate conditions that directly affect food supply and prices. On the other hand, households in your country are highly sensitive to food inflation, which form a large part of their consumption basket. How would you respond to this situation? Would you rely solely on monetary policy, or would you seek help from other policy areas, such as fiscal policy or social programs? Could a coordinated approach, bringing together monetary, fiscal, and environmental policy, offer a more sustainable solution to maintain price stability in such a complex environment? These are the critical questions central bankers in this region are grappling with, and they may not be easy answers. What is clear, however, is that climate change is reshaping the rules of the game for policymakers.
Well, to start, I'd like to briefly highlight the main takeaways of our paper, which is structured around two key pillars: a theoretical framework and an empirical model. First, some key insights from the theoretical side. When we think about monetary policy, the central tool is the policy rate. Adjusting this rate activates the so-called transmission mechanism of monetary policy, influencing aggregate demand, especially in sectors sensitive to interest rates. That said, one of the important observations is that monetary policy tends to have a more muted effect on the volatile components of inflation, namely food prices. This presents a significant challenge as it limits the scope of traditional monetary policy to fully tackle all inflationary pressures.
And this is precisely where climate policy comes in. For example, policies that improve access to water for agriculture can significantly reduce food price volatility by directly addressing one of the key drivers of inflation that monetary policy struggles to contain. These interventions broaden the toolkit available to policymakers. From a macroeconomic perspective, we see that monetary and climate policies are not just complementary, they are mutually reinforcing. While monetary policy focuses on non-food inflation, climate policy helps to stabilize the more volatile food price component. Together, they allow central banks to achieve more effectively the core mandate, price stability.
Now, with this theoretical understanding in mind, we applied the framework to the Middle East and Central Asia, regions particularly vulnerable to climate shocks, as Nordine pointed out earlier. Our empirical analysis tests the framework under two scenarios, one with favorable climate conditions and another one with unfavorable climate conditions.
And here's how we approached it. We looked at the impact of an unexpected monetary tightening, a 100 basis point increase in the policy rate on inflation, under favorable climate conditions. And you can think about it as a situation where water availability exceeded expectation and supported agriculture. We found that inflation decreased significantly by about 1 to 1.5 percentage point over the next 2 to 3 years, a result that is statistically significant.
However, under unfavorable climate conditions, when water stress was acute, the same monetary tightening had a much smaller effect. Inflation decreased by only 0.2 to 0.4 percentage points, and the result is not statistically significant. What does this tell us? It clearly shows that monetary policy is more effective when climate conditions are favorable. This shows the complementarity, the nexus between monetary and climate policies.
So what are the key takeaways here? First, monetary policy has limitation, particularly in economies where food prices account for a large share of inflation. Second, climate policy plays an important role in complementing monetary policy. By building resilience, especially in the agricultural sector, climate policy helps mitigate inflationary pressure from volatile food prices. Finally, policymakers must fully use the tools at their disposal. For instance, the IMF Resilience and Sustainability Facility, the RSF, offers essential support to countries facing climate-related challenges. All in all, we show in this paper that by integrating monetary and climate policies, policymakers can better tackle economic shocks and ensure stronger price stability. With that, we look forward to your questions and comments, and we thank you very much.
Thank you, Mehdi. Thank you, Nordin. Let's now open up the floor for questions. There's a colleague of mine with a microphone who will come and give you the floor. So maybe the young man over there.
Hi, my name is Sadek Ekdami. I'm a consultant in Boston Consulting Group. Thank you for presentation. I have a question about what happens when trade comes in. Like, have you done any analysis around trade? Maybe governments kind of supplanting the climate policy with that in some way? Or how would you see that in terms of changing the direction for policymaker?
So thank you very much for the question. We don't tackle that directly in our empirical model. You will see that we do take into account a large set of controls at the country level. So in order to make sure that what we are capturing is what we are capturing, so the shock of the monetary policy in the two regimes where climate conditions are favorable and unfavorable, but we don't do an analysis from trade to inflation per se. But thank you.
Okay, maybe another question. The gentleman here on the fourth row.
Hi, once again, I'm from Pakistan, advisor finance, one of the province. Pakistan is encountering the issue of climate, and especially due to the global warming. We had massive floods in 2022, and as a result of that, huge infrastructure loss we have faced. In the past couple of years, we have introduced some climate resilience policies such as 1 billion tsunami tree policy by the former Prime Minister, and now this has been changed to 10 billion trees. Despite that, we are having this climate problems. One of the reasons we have identified that, Pakistan as a country has emit very little carbon compared to the other countries, but due to, we have big glaciers and everything, we are very vulnerable. So we are happy to see this climate resilience fund introduced by IMF this year. But what about the countries who are not, who are just the victim of the carbon emission by the other countries? Is there a way to compensate these countries to have much more resilient climate infrastructure?
I can take it. Well, thank you so much for this question. I think we do not, our study is not country specific, but we cover, I think, around 19 countries in the Middle East and Central Asia region. What I can tell you is that the fund, in regards to climate, stands ready to do things that do not deviate a lot from what the IMF do in general. For instance, in terms of economic surveillance, the staff is ready to provide high quality policy advice to authorities, for instance, in the context of Article 4s. And in many Article 4s today, you have sections that are completely dedicated to climate issues. On lending, of course, and as we mentioned, the authorities should take profit of all the tools that are at their disposal. And in this respect, the Resilience and Sustainability Facility, the RSF, is a great opportunity for a country like Pakistan, for instance, in order to tackle and address more effectively these issues. And finally, on capacity developments, the IMF is also providing large arrays of technical assistance, more and more technical assistance that are climate related, in order to equip the authorities, the policymakers, but also the staff of our counterparts at the technical level with the necessary tools in order to better understand, better anticipate, and better deal with the economic consequences of climate change.
Thank you, Mehdi. Maybe another question from there on the fifth row, yes, the lady.
Hi, my name is Nikki. I'm an undergraduate student of economics at Georgetown University. My question was about fiscal policy instruments. I know you touched on the importance of a unified solution between monetary, fiscal, and climate policy, but what fiscal instruments do you think would be the most effective at reducing food price inflation? So like subsidies, price ceilings, et cetera. Thank you.
I can take this one. Thanks for the question. Actually, again, just to get back on what we have done at this stage, we look at the interaction between climate policies and monetary policy. Of course, when we talk about climate policies, we are thinking about a way to improve water availability and the access, especially in the agricultural sector, but we don't really deal with the fiscal per se. What are the best instruments, the optimal package, or the optimal mix to achieve a certain issue? But I think this is something that should be done. And if you look at the fund, we are doing a lot of work between the interaction of fiscal and climate policies. But in this paper in particular, we don't deal with that directly.
Okay, thank you, Nordin. Over there's one more question.
Hi, thank you. It's Ala from Potomac Group. I wanted to ask, do you have examples of central banks in the Middle East and Central Asia region that have already started integrating these climate-related issues in their policies? And if so, can you please elaborate? Thank you.
Thank you so much for this question. I think what we see today is that central bankers are, in so many countries, they are still focused on their main mandate, which is price stability, but they're integrating slowly, progressively, climate dimensions in the conduct and the design of their monetary policy in general. For instance, by implementing stress tests for central banks. However, we're not sure if this should be clearly as a mandate for central bankers. But what we have seen, what the evidence is showing, is that when these dimensions are integrated, the outcomes and the results are better.
Okay. One more question over here.
Hi, thank you. Junaid from Harvard. My question is, a lot of countries in the Middle East and this region have fixed exchange rates, so they do not use monetary policy as others do. What do you do about that?
Can I take it? Yeah, thank you very much for this question. So if you look at the paper in more detail, it is now published. We are doing several types of analysis. So we do take into account the fact that some are in a peg, and so we do the analysis without them. And for those, we are using different instruments. So for example, we use the shadow rate, we use the Fed fund rate. So we are doing several type of robustness tests in order to make sure that our analysis remain robust and strong.
Thank you, Nordin. Are there any more questions? There's one more question there in the back.
Hi, my name is Zaid. I'm an economics student at Georgetown University. In the short term, before climate policies really take effect, what tools should central banks use to keep the inflation of food prices under control?
Well, I think, thank you for this important question. I think in the short term, central banks should be still focused on their main mandate, which is price stability. In the way generally monetary policy works, is the effect through aggregate demand, which affects sectors that are sensitive to interest rate. In what we say in the paper mainly is that in the medium to longer run, climate policies could, and especially policies that are helping and improving water accessibility, they can make the job for central bankers easier by tackling and addressing the food component. And I think in general, the monetary policy in the short run should be focused on the non-food component, and the other policies, mainly climate policies, should complement, not only complement monetary policy, but also reinforce it and facilitate the tasks for central banks.
Thank you, Mehdi. I see there's one more question here up front.
Hi, my name is Adelia. I'm with a nonprofit named First Gen Empower. We mainly work in education, but I was kind of curious, do you see a role for like public-private partnerships within the context of this? We talked a lot about the central bank and government policy, but I was kind of wondering, like, kind of on like a more business level, are there ways that they can also execute policy to help address the food pricing issue?
So thank you very much again. We don't really tackle that in the paper directly, but indeed, yes, if you look at about PPPs, etc. So this is something that we do at the fund. So we are working a lot on those type of arrangement between private and public in order to tackle climate change. In this paper, again, just to remind you of what we have done, we just make sure we are trying to assess the interaction between monetary policy and climate policies. We don't dig further into the private versus public, but what we show in the paper is that by fixing the climate policies, so by allowing the access for water more easy for the agricultural sector, this helps monetary policy makers to achieve the core mandate, which is price stability.
Thank you, Nordin. Any further questions? Maybe last question over there.
Hi, my name is Max. I'm an MBA at the University of Maryland. For the purposes of your paper, how did you decide what was considered favorable or unfavorable climate conditions?
Thank you for this question. I think we tried to measure climate conditions or climate shocks in different ways. The first technique that we used is basically we looked at the country level at the deviation in terms of precipitation for the last 3 years. And this way, we make sure that the climate shock is actually unexpected. And second, we looked also at the level of temperature and also the level of precipitation at the country level. And we made sure that when, for instance, temperatures or when the deviation has increased in terms of precipitation, this is considered as a negative climate shock. When, for instance, the level of temperature or the level of precipitation is below the median or below the average for the country, this is considered as an unfavorable climate condition.
Okay, this analytical corner is slowly coming to a close. Maybe I can ask Mehdi, what are, according to you, the takeaways of today?
Well, thank you, Sebastian. I'll give you 3 takeaways. First is that monetary policy and central banks, they have limitations, especially in economies where food consists of a large share of the consumer price index. Second, climate policies, they can help building resilience in the agriculture sector, and support the implementation and the success of monetary policy. And third, the authorities should use all the tools at their disposal. And in this regard, here at the fund, we have something called the Resilience and Sustainability Facility, the RSF, that is designed to help the authorities, on the one hand, to enact the necessary reforms for mitigation and adaptation strategy to climate change, and also provide them with the necessary funds in order to fund this issue.
Thank you, Mehdi. Thank you, Norden.
Thank you.
Thank you.